Welcome to Power Charting. I am your host, Bruce Fraser. Thank you for being here. This is for April 8th, 2022, recorded on April 7th. Wyckoff Principles within Principles was the topic of my most recent blog post, and this was a discussion about the current market environment from the perspective of the S&P 500 index. So we're going to discuss that. And then also we recently, yesterday, had a epic presentation available to the public on Wyckoff Market Discussion, which we hold every Wednesday afternoon at 3 p.m. Pacific time. Roman Bogomazov and we just had a fantastic session. It was a public session, so you can go watch it, watch the recording. It was epic. It went a very long time. And so you may want to watch parts of it that interest you. We definitely encourage you to go check it out, and I'll show you where to do that. But also keep in mind that we're running a special promotion. We think that we as a community, we as Wyckoffians in the Wyckoff Market Discussion did a fantastic job of navigating this very difficult market environment since last fall. And we talked at length, strategically, tactically about these markets, the rotation, the inflation, the way the markets were trading throughout that whole period. We'd love for you to become a member of our community and check out what we're doing. And we think that you will find that it's very worthwhile to participate and attend these sessions each week. So let me just start with a discussion about the blog, which was on April 3rd. And this is Wyckoff Principles within Principles. And the idea here is that there are the Wyckoff concepts at work in all time frames. And so we're going to have a look here. Here's the very big picture. This is the Wyckoff S&P 500 trend with my interpretation of the unfolding of this. This is a distributional interpretation that we're looking at. Preliminary supply, deep reaction down to the demand trend line, buying climax into the top of this trend channel again, and then an automatic reaction, an up thrust, which took out the buying climax and tested it and then failed very, very aggressively back down into the bottom of the trading range below the low of the reaction off the preliminary supply. So this sets up the conditions for a possible distribution. Now, Principles within Principles really addresses a couple different things. One is we can see a small distributional structure in here, potentially a bigger distributional structure out here. And also there's in this little area where it says potential green shoots, there is an internal accumulation type structure that ultimately led to an important advance in the market, the best one of the year. And so let's take a minute to look at that. Now, I'd like to point out that when you go to the blog, you click on the chart and you get an active chart. And this active chart is brought up to date. So here's April 7th, and here's what subsequently happened since. You had a climactic surge, a throwover of the preliminary supply point, which is resistance, just as it did here, and then a sharp failure back in. And look at the gap that formed right here. That's interesting. Is that a breakaway gap? Is that the start of something bigger? Well, the bullish interpretation would be that we would like to see it hold the 200-day right here, become dull and quiet and consolidate in this area, and then be able to go up again. And there is a case to be made for that. And also, as I have pointed out here in power charting, that there was a number of bullish green shoots. breadth non-confirmation of the lows, a solid accumulation type structure, stronger bullish percent data, not only in the S&P, but in the Nasdaq 100 and in other areas. So very encouraging. And then also notice the downtrend was penetrated right here at the level of this support line. It also broke out, had a really good bullish bar, and then subsequently rallied. We were able to participate in that rally. Okay, well, let's go back here. Here's back to the newsletter. And then here is the idea of principles within principles. Now, this is an accumulation structure in the yellow shaded box that occurs inside of, now this is a 2-hour chart. So we're zooming in and you can see the selling climax, which is the idea of a principle within a principle, because this was a sign of weakness decline on, and let me go back up and show you this. This is right here. This sign of weakness right here is that selling climax on the 2-hour chart here. Now, then a very important automatic rally, which sets up a range-bound condition, all classic Wyckoffian concepts. And so now we have a range-bound condition, and this gives us the ability to start to look for tactical places to participate in a potential rally. So this secondary test, for those that are inclined to sell short, could be used as a short selling opportunity. This test of the selling climax, because selling climaxes are dramatic declines of acceleration on very high volume, and then a reversal, which shows that there's good support there with, it's the reason we call it a support line, and then an attempt to come back down to this level, and it went through on a gap and then reversed immediately back up into the area and came down for a test. These are all tactical places for action. And these tests here become places where positions can be put on for a potential rally. And note that the volume is drying up on this test of this low and on this test of this low. And at this point, we could go in and look at the breadth characteristics, which we did at the time, and saw that there was positive divergences occurring with the internals of the market here, showing stocks above their 50-day moving average were improving. Stocks above their 200-day were improving. Advanced decline ratios were improving. And then this downtrend line was broken and a rally up to, guess where? The resistance line. So this is an interesting place because now we are back up to the top of the structure, which we have to ask the question, is this accumulation or redistribution for another move down? And so a gap, look at this gap. This gap is climactic. This tells us that this is exhaustion of this upward trend that occurred into this high, into this upthrust, and then a reversal down. Volume did expand somewhat. What we need to see now to show the ability to have reaccumulation is to have the ability to consolidate in this area. The duller and quieter it gets, the sooner the better. And if it falls back too far into the trading area, we're going to assume that one, this is redistribution, or two, that there's more accumulation work to be done, and volatility down to the support area would show either of those two as a potential. This is tactically a place to act. We're always acting in uncertainty. So let's keep that in mind. But this doesn't mean that we don't have high probability junctures to take positions on. And so also let me point out about these blogs is that you can click on the chart and bring it current. So now we see a sharp break down, attempt to rally. It rallies in a very poor quality rally, diminishing stride of the advance, narrowing bars into the area of the resistance, and then it turns back down again. But it actually becomes a little more virulent in that it drops faster, further with a gap. And so the inability to be able to rally here would suggest the ability of more weakness to come in. So far, it's not showing the ability to rally up sharply, and it's just consolidating in a tight range. You can see the tails in these bars above the market, also tails below the market. But if it can't get ahead of steam and get back up to resistance and through it, and potentially consolidate more tightly in this area, then we have the risk to at least go down to the area of support. So this is the way Wyckoffians think about things. We're always thinking in terms of scenario building. And this allows us to be able to act, set stops, set them in proper places, and then be able to act in a high probability way. Okay, so now with that in mind, let's keep going. So again, remember, you can go in and zoom in. You could now go in and take this chart, save it, put it into one of your files to keep further track of it. That is, if you care for the way that I've set up the work in this chart, which is my own artistic license, so to speak, with the market. Now, this is a point and figure chart that goes back to March 16th. And this is a 3-box method daily data point and figure chart. And again, this takes us to the concept of principles within principles, because note here, this red area across this zone, this red area is a distributional type structure, and this is in the area of a potentially larger distribution type structure. But this in here now can be counted. It's 9 columns times 3 times scaling of 25 points, S&P points, and it gives us a countdown to 4125 to 4050. And lo and behold, 4125 is where this ultimate decline went to, and a very sharp advance occurred. You can really see it in the point and figure chart, which shows that that was a good place of support. Also, it's below this 42.25 level, which was what we called the selling climax. And so a really sharp advance shows that there's some demand in this market at that support area. You can see it on the point and figure, and a point and figure count forms. And this is that area that we just looked at on the 2-hour chart that was in yellow shading. And let me just take you back to that. There it is. So this area here is the P&F count segment number 1. And this count area we're taking with the jump up and out, we have the potential to give us a count objective range. And this gave us a count, which was 7 columns times 3 times 25, 525 S&P points, nothing to sneeze at. And this gave us a count up to 4625 to 4700, and it went to the intraday high 4637.30. Well, notice that's not 50. That means that 4625 was the highest entry on this point and figure chart, and it's a hit. It perfectly hit the minimum upside objective of that principle within principle, small accumulation structure, which we could see well on the 2-hour chart, and it gave us a count, and that's exactly where it went. And then after that, we are experiencing market weakness with increasing volatility back into the trading range. This is the way we work our way through markets using the Wyckoff methodology. Now, a larger count is available to us. This is part of the reason for why we think in terms of reaccumulation, a backup where we could have an attempt to maybe come back into the trading range, not come all the way back down. Here, let me go back to this. I can see I'm going to use the whole my whole episode just to talk about these charts, because I just go completely down the rabbit hole of talking about these. But here, this could be some kind of a last point of support reaction, sets up this larger count, which means that the count that we may have here could even grow larger than what we have on the chart. And I'll go back and look at that in a second. But this pullback here, if it goes further, and it may just hold here, go back up to resistance and then develop a tight range, but that backup or this pullback into a last point of support gives us a count that potentially takes the S&P to a new high. And of course, we're going to have to really watch for that. But let's go back to the point figure. Well, what is that count? So from here over to the selling climax low is 15 columns times 3 times 25, 1125 S&P points, substantial. And that count could actually become larger if we get somewhat of a pullback in here, and we'll update this chart in the future. But so far, from this low over to the selling climax, we have a count 5250 to 5300, which takes us above the 4800 high on the S&P. We also can go in and look at the internals. We can look at the breadth, stocks above their 50-day, stocks above their 200-day. We can look at the advanced decline oscillator, et cetera, and look for those non-confirmations of weakness in the chart. My preference is I'm a trend follower. I'd prefer to see the market go up, go to new highs, as I'm sure most of you would too. Some short sellers don't want that. Nobody gives me a vote. Nobody allows me to decide which way the market's going to go. I've got to go with the market. And so here I'm just trying to read the market as competently as I can. And of course, I want to share that with you here. And also I want to share it with you in the Wyckoff market discussions, as does Roman. And he's extremely good at this also. Okay, so having done that, do check out this blog and get these charts. You can even capture this point and figure chart and put it in a file for further reference, and we will update this chart in the future. Last thing I want to do is show you the very powerful use of trend line analysis in the point and figure charting, because note the upward stride of this advance and how beautifully this demand trend line was able to show the upward stride. And when it finally did break the upward stride, look at the incredible drop from 4,700 all the way down to 4,200 without as much as 1 3-box reversal on the way down. So this is just a huge wall of weakness that occurred here, and it set up, of course, the selling climax and the range bound condition. So quite spectacular, and the trend line and trend channel really kicked that off. Look at that beautiful overbought condition right there, where this point and figure count went to on distribution. Oh, and I don't know, did we talk about this, but that point and figure count was a perfect hit, 41.25. And potentially, if this is distribution on a larger scale, we may have distribution that goes all the way across this area. Okay, I've got about 7 minutes left, and I'm going to pause for just a sec. I'll be right back. We are back. And here, I love these longer term charts. And I know people, they go, well, yeah, why do you look at the Dow? Why do you keep looking at the Dow? Well, the Dow, I think, is an important psychological index. It works so well. It works well on point figure counting. It works well on trend analysis, et cetera. But these other charts, also other indexes, have a similar look to them. So it's not, the Dow's not alone. Let's put it that way. This is a beautiful trend channel that was formed in 2011. And you can see we used reverse use of trend lines, where we just picked up these periods across here, drew a parallel across these lows. Look at how it picked up these oversold conditions. This is a stochastic, very long-term stochastic. This is the Great Recession, 2007 to 2009. And Note the stochastic, once it got the directionality of a downward move, look at how it just persistently went lower and lower throughout this whole period. Well, I want to point out from a long-term perspective that we have something that potentially could be similar to that here. This last bar that we have, which is through March 30th, sorry. And so that bar right there, you can see where that little hand is. It's rallied up to the top of that overhanging supply trend line, and it's hanging right there. To me, that is a position of vulnerability. And we want to be really careful here because look at what has happened. Note this period right here. This is the COVID decline. Once it hovered here and just hung out and started to break, it broke quite volatilely downward as it did right here. It tried to rally, hold that supply line right there, and then huge volatility. That was the December 2018 decline. Pretty scary decline at that time. Little bit more of a mundane decline, but still very painful, was this one that went down in 2 stages to the oversold line back here. And that was in 2015, 2016. So here we are. This is a very important place, as I just showed in the S&P, for the market to rally. It's important that the market rally out of here because of the vulnerability of the position that it's in at this point in time. Also, look at the directionality of this stochastic. It is now pointing down from an overbought condition. It's come back through this overbought threshold and is turned down. And this also tends to coincide with important volatility in the market. So this is just a point of warning, of concern for us that we need to pay attention to as we go forward in time. And I want to show you another chart here. This is the Nasdaq 100, and this is that same time period, just to show you that the Dow showed this incredible upward stride of the trend, while also the Nasdaq 100, which really was the leader, the granddaddy of this whole bull market, was these mega cap Nasdaq 100 names. And here is more traditional use of trend lines in here. You can see these are the points that this trend line is drawn on. Look at that, a very small period of time, 2010 to 2012, and it set the stride for this advance. And all these touches came just off the definition of those lows. It's a classic Wyckoffian approach to trend line and trend channel construction. So look at the overbought conditions that we had through this whole period. Now, what I have down here on the bottom is something a little different. And this is a put call ratio. This is a 10-week moving average of put call ratio. And I want to make a point about this because I think we're looking at an secular extreme of bullish sentiment, of speculative bullish sentiment that has occurred from 2020 to the present, as the Nasdaq has bulged over the top of this upward striding trend channel. It's gone over the top in an overbought condition. And this overbought condition is, I think, a point of warning, because we do not want to see the Nasdaq 100 fall back into this channel because of the discussions we've had about the volatility that occurs when we get back into this channel from the high to the low. And so we're looking at it working its way down, and the Nasdaq 100, which has been the leadership in this market since 2010, 2011, is now losing its leadership position. It's no longer outperforming other areas of the market. It's becoming a source of capital by these large institutional composite operator types who have raised cash, raising cash away from these mega cap, overpriced, overvalued stocks and going into other areas of the market, AKA CRB, commodities, and so on. So with that in mind, let's keep looking at this, because this is a secular extreme of sentiment that's occurred here, and after being kind of in a range-bound condition. Now, last thing we'll look at here in about the 45 seconds that we have less, here's the ARK Innovation Fund back in the last couple of years, and look at this acceleration. I don't mean to pick on ARK, because they're good managers, they know what they're doing, they're picking these incredible growth companies, but look at this, what we would call a hypodermic advance. This is a inverted V top followed by distribution and a breakdown. All of this occurring while there's extreme bullish sentiment in the put call ratio. And over here, we can see that this is a 15-year history of the Nasdaq 100. I'm going to let you look at this. We'll come back to it next week. But look at the extreme bearish sentiment back in 2010, 2011. This is 2008, 2009. And so extreme bearish psychology to extreme bullish psychology at the end of this bull run in Nasdaq. With that, I'll say goodbye. Thanks so much for being here, and we'll see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.